Good day. I am Callistus Mahindi. In today's lesson, we will be looking at IAS 12, in particular, how to calculate a company's current tax expense in terms of IAS 12, where there are permanent differences involved. End of this unit, you should be able to differentiate between accounting profit and taxable profit. Explain what is meant by permanent difference. Calculate taxable profits resulting from permanent differences. Calculate the current tax expense, as well as determining the effective interest rate. So, what is the objective of IAS 12? The objective of IAS 12 is to provide a basis for the calculation of a company's income tax. So the question arises, on which amount is company income tax levied? Company's income tax is levied on a company's taxable profits. Look at the income tax framework. The accountant's view is different from the tax authority's view when calculating current tax expense or the income tax expense. From the accountant's point of view, taxation is calculated on accounting profit, and accounting profit is determined in accordance with the International Financial Reporting Standards, whereby income minus expenses gives you your profits. However, from the tax authority's point of view, income tax is calculated on taxable profits. Taxable profits are determined in accordance with tax legislation, and therefore they are calculated based on the taxable income minus tax-deductible expenses. Accounting profit needs to be converted to taxable profits to calculate income tax payable. As a result of the differences between the accountant's view and the tax authority's view, differences in the calculation of tax occur. These differences can be classified as a temporary difference or a timing difference or a permanent difference. In this particular lesson, we are only concentrating on permanent differences. These are differences that are never resolved because the accountant's view and the tax authority's view never align. So, for example, income can be earned, but the tax authorities will never tax it. Or expenses are incurred, but the tax authorities will never allow these expenses as a deduction in calculating taxable income. Let us look at why permanent differences occur. Permanent differences occur when an amount enters the computation of accounting profit in the reporting period under review, but it never enters the computation of taxable profit in the current or any other reporting period. So this may be exempt income or non-deductible expenses. So for example, dividend income is exempt income that the tax authorities will never tax in Namibia. Or we have donations that are expenses that the tax authorities will never allow as a deduction in Namibia unless there are specific donations to certain institutions. How do we convert accounting profit to taxable profit? We start with the accounting profit before tax, which was determined in terms of the International Financial Reporting Standards. Then we adjust for permanent differences. That amount will give us an accounting profit that is taxable in the current year or in future years. Then we make an adjustment for the movement in temporary differences. Thereafter, we will get our taxable profit. The taxable profit is the amount that is taxable by the Namibian Revenue Authority or any other tax authorities. So let us illustrate how to convert accounting profit to taxable profit using two basic examples. We'll start with example 1. Assume the accounting profit amounts to 800, including a dividend income of Namibian dollars 100. Compute the taxable profit. Your step 1 is to convert your accounting profit to taxable profit. So the taxable profit is equal to the accounting profit minus the exempt income. So in Namibia, dividend income is exempt from taxes. So if we calculate it, the accounting profit of 800 minus the dividend exempt income that the tax authorities will not tax gives us taxable profit of 700. Now look at example 2. We have accounting profit of 800 Namibian dollars after deducting donations made of 100. You are required to calculate the taxable profit. So the taxable profit in this instance will be the accounting profit plus non-deductible expenses. In this instance, the donations made. So in Namibia, the donations made will not be allowed as a deduction for income tax purposes of a company. Therefore, the taxable profit will be the accounting profit of 800 plus the 100 non-deductible expenses of the donations. Therefore, in total, the taxable profit will be 900. Tax rate implications resulting from permanent differences. As accounting profit will never equal taxable profit, the effective tax rate and the standard rate of tax will not be equal. In such instances, a tax rate reconciliation will be needed in your tax expense note to reconcile from the standard rate of tax per legislation to the company's specific tax rate. In the slides, we will not deal with the tax rate reconciliation. This will be dealt with at a later point in time. The standard tax rate is the prevailing company tax rate in the country, while the effective tax rate is calculated by taking the current tax expense and dividing it by the profit before tax. This is expressed as a percentage. Deal with an example to illustrate the calculation of current tax as well as the effective tax rate. Company A reported an accounting profit before tax of 1,050,000 for the year ended 31 March 2025. The profit figure already includes interest income on Namibian government bonds of 70,000. This interest income is exempt from income tax. Further, the profit figure includes fines paid for environmental violations of 25,000. This 25,000 is not deductible for tax purposes. The prevailing corporate tax rate is 30%. You are required to calculate the current income tax expense as well as the effective tax rate for the year ended 31 March 2025. You can pause this video here and attempt the question on your own before going to the suggested solution. Suggested solution. In order to calculate the taxable income and the current tax expense, we have to convert accounting profit to taxable profit. The accounting profit that we were given was 1,050,000 Namibian dollars. We then adjust for permanent differences. The first permanent differences was the interest income, which is exempt. We therefore deduct this interest income from the accounting profit, and we add back the environmental fines that are not allowed as a tax deduction. We will then get a taxable profit of 1,005,000 Namibian dollars. To calculate the current tax expense, we take the 1,005,000 Namibian dollars times the prevailing tax rate of 30%. We will then get an amount of 301,500. This will be the income tax expense. The effective tax rate is then calculated by taking the current tax of 301,500 divided by 150,000. So the current tax divided by the accounting profit, and we express it in terms of a percentage. The answer that we get is 28.71%. Right. In this lesson, we have learned the difference between accounting profit and taxable profit. We have learned what is meant by permanent differences, and we have learned how to compute taxable income, the current tax expense, and the effective tax rate. In the next set of slides, we will be looking at how to calculate current tax expense where there are temporary differences involved.